Do you have high-interest credit cards that you can't seem to pay off? Want to take the trip of your life but can only make monthly payments? Want funds to help with your children's education or consolidated debts? How about doing home improvements? If you own a home and have equity, there may be a solution for you. Before I can explain further, let's first define the word home equity. Let's say your house is worth $1 million and you owe $500,000. The difference between the worth of the house and the amount you owe is $500,000. Putting it another way, if you were to sell the house, you can net out $500,000. This is called equity. You may not realize this, but selling the house is not the only way to access this money. What if I tell you that you can keep your house and access that equity to consolidate your debts, pay off high-interest credit cards, or utilizing funds to take care of any other plans? How do you do this? By opening an equity line of credit or an equity loan depending on the needs. Both of these options utilize the home as a collateral to access the worth of the home, with many lenders allowing up to as much as 85% loan to value. So let's define what these two options mean by understanding loan to value. Let's continue with the house that's worth $1 million. If a bank says that they will loan up to 85% loan to value, what this means is that they will loan up to 85% of that $1 million or $850,000. If you have a balance on your first mortgage of $500,000, that means that you would have access to an additional $350,000 to cash out or take a loan against the house. This also means that if you ever decide to sell the house, you would have to pay off both of those loans and net out $150,000, keeping all factors the same. So now let's take a look at equity line of credit versus equity loan. As indicated earlier, an equity line of credit is an open loan that you can take out against your house and access on a needed basis. Once you are approved, the credit is open with variable interest rate that isn't charged unless you access the money. You have the flexibility of using the money and decide when to pay it back, though there is always a minimum payment that is required. There are certain lines of credit that will fix the interest rate once money is used, while others will remain a variable. There are also terms that can be placed when the line of credit may expire after a certain period of time. If there are any balance still owed when the line of credit expired, the bank usually will work with the borrower on a payment plan. This type of option is attractive for those who want to establish an emergency fund for the just in case or need flexibility in accessing money short term. An equity loan is similar to equity line of credit, except the loan amount is definitive, with fixed interest rate and fixed terms. The attractive part about this product for many is that the interest can be fixed and the borrower can access the money to consolidate debts or pay off higher interest debts such as credit cards and car loans. If the loan is taken out to repair or upgrade properties, the borrower may also be able to take tax write-off up to $750,000 loan amount in the current year. The caution is, though the money may be accessible, it is still a loan, and if not planned wisely, it can be detrimental. Please make sure that you work out a solid payment plan or speak to a financial advisor prior to taking out your loan to ensure that your budget allows you to take on any planned debts. Come back next time when I will share some strategies on how to utilize your equity to build more wealth.